G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Wargent Property Buyers. I'm here, as I am most weeks, with Chris Bates from the Alcove Group Mortgages. Chris, how's your week been?
Oh, it's been all right, Pete. If you're listening to this now, it's probably Sunday or Monday. Probably a bit of a lads' weekend, actually. We're going camping, and weather's looking good. So I'm heading over to the basin on the northern beach. There's a few dads just to, do a bit of fishing and hang out. So that's what I've been up to. Went to Newcastle last weekend and spent some time with my mum up there. Didn't get a great sleep on the Friday night because my boy woke up when we got there after a 2-hour drive, and for some reason he did not want to go to sleep till 1 a.m. So that's what's been keeping me busy, Pete. Work's been busy too. We're in peak season, as you are, with property purchases, right? It's the middle of spring. There's a lot of people have been looking at properties for a number of weeks. There's a lot that maybe missed out on one or two, so their desire to buy is really high. And we've had a number of transactions sort of over that sort of 2-3 mark, which I wouldn't say we've had too many over the last few years. That whole market's been sat on its hands and didn't want to transact, whether they didn't want a bigger mortgage or they couldn't get the servicing, or didn't want to hold, was worried if they had to sell and buy at the same time. But that's come back over the last few weeks, which is a nice change. What about you?
Yeah, I'm a bit jealous. I haven't had a boys' weekend for so many years, I can't even think. But I always used to enjoy going to Yamina Beach or Ettalong or those kind of parts of the coast. But those days are behind me now. I've got kids, or at least I haven't had one for a long time. I've been I'm actually in Perth today, but I'm heading over to Melbourne. So by the time this goes to air, I guess I'll be in Melbourne for the AFL Grand Final. I think the thing I've noticed in Perth, it's been about 12 months since I was last here, at least according to my Facebook reminders. And I think the thing that really strikes me is that, I guess as somebody who travels a bit, if you go to Dublin or Denpasar or Dubai or any of those kind of cities, when there's been a housing boom in prices, you know all about it because everything's under construction, there's cranes everywhere. I guess in Perth, we're just not seeing that. I'm not going to say you can hear a pin drop, but it's not really, I would say there's nothing more under construction here than there was a year ago. And I think the missing piece in the puzzle for this cycle so far has been units, apartments, those sort of big apartment towers that you normally see in the CBDs of Australia's cities. I think, yes, if you go out to Fremantle or suburbia, there's a bit more sort of construction happening for detached houses. But units, there's nothing more, I would say, under construction than there was a year ago, despite this massive boom in prices. So I suppose in terms of what that means for the cycle, I think, for Perth, anyone who thinks we're at the market peak is delusional. I think it's just, I think there's fewer properties than there's ever been for sale in Perth now, and population growth of around 2.5% for the city. So we're just not building anything like enough. And I think that's just more broadly being reflected across the whole country. I think it's, yes, we're getting some more houses under construction in a lot of places, but apartments seem to be very slow to get out of the ground because of just the cost of building, I guess. So I don't think the laws of supply and demand have gone away. I just think the supply response this time around is very slow. And at least a part of that is in this cycle, we just don't have that many non-resident or foreign buyers in the market. They've been effectively taxed out by stamp duty surcharges, and therefore it's all down to the local buyers to buy. And I think a lot of people have been scared away from new apartments in the previous cycle. I guess a lot of construction defects and underperformance from in terms of the properties that they bought in the previous cycle. So, I guess that's been my main sort of observation in Perth is that, the housing market is still booming, obviously, but there's just not really been much of a supply response at all, given what's happened to prices effectively doubling over the last 5 years. So, it's quite surprising, really. I was expecting to see a few more cranes on the horizon, but no, not really. So, it's pretty interesting. Is that the same in New South Wales?
Yeah, it's interesting you say that, Pete, because if you think about as prices go up, then there should be, feasibility for developers should be better. And then they go, we can make a bigger margin. And all of a sudden, the developers pile in, and then, that sort of margin sort of gets eaten away because they've got to be a bit more competitive and et cetera. So you haven't really seen that build. I think it's just due to maybe it's a lot of developers have gone under, a lot of builders have gone under, a lot of builders are doing other projects, whether it's building schools or freeways or, other types of, rather than just say resi. And, maybe they see it as more of a higher risk and they can make better margins if they go and build other things. And, I think you're right. The investors aren't really in that market. So if the owner occupiers are buying the new stuff, and that stuff's a lot more expensive to build because they demand a lot more rather than what the investors would have put up with, at 2015. I think even Domain had an article, I think I read it last night, and it was just showed the double-digit growth over the last 5 years, and it was just units. And I think so the cat out of the bag. I mean, I remember 5-10 years ago, I was warning about my concerns around just the fundamentals between off-the-plan investing, and it wasn't really sort of the mainstream sort of view. There was a lot of people spruiking that, and I feel like a lot of the spruiking is now happening in the buyer's agency world, if I'm honest, and borderless investing buyer's agency, and and they're just betting on sort of short-term growth or off the back of short-term results for other clients. The supply hasn't really been hitting. I mean, there's a lot of talk about it. We spoke about it last week with Chris Minns in New South Wales, changing zoning, communities fighting back. I mean, Inner West Council just next week doing basically a presentation to the community of their plans, and they've got their response to the transport orientated development sort of hub, their alternative strategy. But I think even though zonings are getting changes, it doesn't mean that developers can make money or want to build. They'll only build where it stacks up.
It does seem that way. I think on the insolvencies front, there was a big sort of news article breaking over the past week or two about in the private credit world, some funds getting locked up with La Trobe. Won't go into the detail of that because it's obviously an evolving story. But I mean, there's been a lot of insolvencies across developers, especially in the residential space. I think, so your point about buyers agencies, I mean, I don't get too involved in industry gossip so much these days, but if you look at some of the most senior people in the industry, like, for example, Ben Kingsley at Empower Wealth, also people like Melinda Jennison, they've been warning about this for quite some time, is the barriers to entry in real estate are pretty low, to be honest, and there's been hundreds and hundreds of buyers agents come into the industry in recent years, often buying not just locally in a market that they understand, just buying anywhere all around the country, finding ways around the legislative requirements about having licensing for requisite states and so on. I think if it's done well, I suppose you can catch the wave. But of course, what you're missing there is the local insights and the local knowledge. And I'm sure there's going to be some stories sort of evolving over time about people sort of having some suboptimal experiences, not least because a lot of these new entrants to the industry just don't have that much experience. So, caveat emptor on that front. So, yes, and I think one of our news stories this week actually talks about sort of that pain and gain reports, and the people who've been losing money over the past 10 years have been by and large those who did buy apartments off the plan 5 or 10 years ago, and they're finding now that when they come to sell secondhand, the product just isn't worth as much as they would have expected. But in the established market anyway, auctions clearance rates were at a 4-year high this week, Cotality reported. So obviously there's a lot of activity sort of pumping up in the established market, even though sort of the other news out this week, just on the jobs market, it just seems like the economy's just not quite getting firing yet. It might just need a little more assistance either from the government or the Reserve Bank.
Yeah, I mean, we're still looking, when you look at the rate tracker, right, so it'll be sort of low threes. It's probably gone a little bit further towards more cuts than it has over the last week. But, maybe still 2 more in the tank, whether it's this year or early next year, time will tell. But, I don't think that's holding back buyers. I think buyers are just wanting to be ahead of it now. They're saying, well, I don't know how many more are coming, but I know there's been at least, 3 so far, and there could be more to come. So we're definitely seeing that. And you can see that through auction clearance rates and time to buy and consumer confidence. I mean, you mentioned some also interesting articles, Pete, around sort of search terms. I saw that article too, where granny flats are making a bit of a comeback. And I think that, this sort of multi-generational sort of desire to live with family and pool resources, I think this is going to be a trend of the 2030s. I think that we're going to shift to a world where, sometimes it's better to stay together as a tribe versus splitting up and all having our own houses. And, whether it's taking care of older parents or getting help with younger kids or being closer to family, I think that's going to be something we see start more and more in 2030s.
I think you're right. I mean, I think it as well speaks to the supply shortage. And I think actually even a lot of investors are looking to buy properties with granny flats, or even buy a place that has the potential to maybe spend 100K and put in a bit of extra space in the yard or out the back. Just one of the things I've observed when I went to the UK, I went to a few sort of property networking events and seminars. And I think the thing that's really changed there for investors over the past decade or so is, I think if you went back to the pre-financial crisis days, people generally as investors, they were borrowing as much as they could, and they were going into London or the sort of really expensive markets like Oxford and Cambridge and those kind of high capital growth areas. Well, that's completely shifted. People are now looking into the regions, and there's loads more focus on rental return. Just something I've noticed as interest rates have gone up, in that people are looking for dual income or granny flats, Airbnb. They don't call them granny flats over there, but it's the same principle. Or things like sort of rooming accommodation or houses of multiple occupancy. So I think we've seen a bit of that in Australia too in recent years. Maybe not quite so much focus on yield, but certainly people seeking out the cheaper markets, looking around regional Australia to get more attractive entry points, and probably more so focusing on sort of houses on good blocks of land and less so on apartments. So I think there's been some sort of trends that we've seen in Australia too in recent times, probably stemming actually from, as you said, in 2015, when a lot of people got burned buying sort of lower grade or lower quality apartments that just haven't delivered for them.
Yeah. And so we should crack on with 3 stories this week, Pete.
We will. So this is our weekly 2 cent segment. So we go through the big 3 property news stories of the week, Sunday at 7 a.m. in your podcast player. And then at the end, stick around because we'll do a couple of your listener questions in our Q&A segment. So the first story this week relates to changes in the visa landscape. So one of the big stories in the US, it was announced by the president over there that the US would be introducing $100K US fee for skilled visas, which I know you always have to be a little bit wary about announcements from the US because they don't always follow through. But if that does come to pass, there'll be some very significant implications for migration to the US, particularly from India. Because yes, although a big tech firm might be able to pay a $100K visa fee, what do you think about, for example, in academia or higher education, universities? There's going to be some real problems there if that sort of visa fee is introduced. I think in Canada in recent times, we've already seen a massive change in sort of student visa grant rates. I think about sort of 80% of international student applications have been knocked back in Canada. So, Australia is, I think historically, we've had very high visa grant rates for students. So they was tracking sort of 95% or thereabouts. I mean, yes, things have come off, and the introduction of fees in Australia has certainly seen the beginning, at least, of a decline in the number of visas granted or enrolments for international students. But I just think there's a potential opportunity for Australia if they get the policy mix right, because yes, the US is obviously looking to wind back sort of various visa streams for immigration. Canada's already done it. I think if you look in Europe, it's really clear when you look at polling, whether that's in France or United Kingdom or Germany or any number of countries across Europe, there's a big sort of backlash against big immigration policies, and the sort of hard right parties are leading the polls all over the place. So yeah, I'd say yes, Australia's seen sort of that goose that lays the golden egg. They've sort of been knocking back a few more student visas, but obviously all of those people who would have been looking to go to the US or the UK or Canada, there's a huge sort of pool of people out there and potentially a lot of skills and talent that is going to be looking for a home. And Australia historically has been very welcoming to that. What do you think the potential implications might be down under, Chris?
Look, it's a really topical one, this, right? We get a lot of comments around migration story, and that's our issue in our property market. But we've had rising property prices for a long, long time, and yes, that's a part of it. But there's also a lot of other reasons that force property prices up, and people can one looking for someone to blame, right? And often a lot of people just go to new migrants rather than a lot of the other bigger issues, like the government, for example, for not being, I guess, better at releasing supply and having a real strategy around our property market, and just accepting that mum and dad investors are just going to solve the problem and the market will just solve itself. They haven't. And then when they do come in, they come in with demands, inducing policies to win votes, like 5% deposit schemes. So I don't know, Pete. I mean, do you think there's an appetite in Australia to sort of make major cutbacks to our immigration, the way that we go about it? Or do you think that both parties are sort of sold on a big Australia? Yeah, they might make, small changes to things, but ultimately we just need to accept that the system here in Australia is looking for, increasing our population.
I think sometimes you need to look at what people actually do rather than what they say. And certainly it looks as though through 2025, there's been an increase, a re-acceleration in population growth. I think the Fin Review reported this week that new student enrolments over the year to 30 June were down by 16%, with the English language college sector down by 38%. And I just quote here Phil Hollywood, who's the chief exec of the International Education Association, quote, the world's highest non-refundable visa application is doing the government's work for it. So Labor increased the visa application fee twice in a year. That was up to $2,000. It was previously about $710, according to the article in 2024. So I think, the margin, maybe we're sort of seeing a bit of a crackdown, in particular on those English language schools, which are closing down now. So maybe some of the sort of at the fringes, maybe there's been a crackdown. But I just don't think that if you look at both sides of politics, what they have done over the past 25 years or so, particularly the past couple of decades, they've been running very high immigration, abnormally high, actually, when you compare it to other parts of the world, population growth of about 1.5% or higher. I think I just don't think there's a big appetite to really cut that back too much. And it certainly isn't showing up in the numbers just yet for overseas migration. As you said, it's a hot topic across Europe, but that's really partly because it's been so badly mismanaged in countries in Europe. Australia has generally done better with the intake and just managing things. But yeah, of course, there's a lot of pressure on rental markets, and that's one of the reasons why it's getting such a lot of, just so many headlines at the moment, because we've got a real shortage of housing.
Yeah, I think it's one of those ones that I think it's just people just maybe look at it one-sided of the coin, and maybe you cut back immigration, but who do you not let in? Who do you let in? What does that impact on our jobs market? What does it mean to our universities and our future workers down the line? What does it mean to our tourism or our retail? Like, there's just a lot to it, and a lot of people are sort of just blaming that a lot of new people have arrived, but I don't think they see the whole picture, if I'm honest. But should we go on to story number 2, Pete?
Yeah, let's do that. Just as an aside, I went to the Museum of Western Australia, Bula Bardet Museum, with the kids this week, and there's all different sections on the sort of geological history of Australia, and there's a little section on 10-pound poms, and also Australia's migration history, and the little sort of quiz questions that you can do. And it's interesting just watching the kids answer the questions, because there's a lot of there's like a survey you could take on is immigration at the right level? Do immigrants make a positive contribution to the economy, and what we should do prospectively? And actually, when you look at the responses, it's firstly interesting just watching the kids think through all these questions. But when you look at the sort of survey responses, I mean, generally, despite some of the challenges we've had, there's a very sort of positive view of immigration in Australia, not least because 30% of Aussies were born overseas anyway. But generally, people have seen a lot of the benefits. I think it's just the quantum has been challenging over the past sort of 12 or 18 months. But generally speaking, things have been seen in a positive light for Australia. So that's good to know, at least. Second story of the week from Cotality. Sellers make record nominal gains. So the sort of typical gain on sales prices was $315,000 in the most recent quarter. That's up from the decade average of $250,000. In fact, it's a record high in nominal terms. So I think obviously that reflects the stronger sales environment. In Brisbane, the median gain for sellers was $400,000, with 99.7% of buyers making a profit. I'm interested to know who the 0.3% of sellers making a loss would have. Somebody has achieved the impossible there by the looks of it. But yeah, I guess just looking at those numbers, you would say from a tax reform perspective, capital gains tax might be a target. I was just doing my tax return this week, actually, and I had some CGT to pay, which is a bit of a gut punch. And if you look nationally, about 5% of sales made a loss, and mostly, as previously noted, that relates to units in Sydney and Melbourne, where people bought off the plan maybe a decade ago, or at least over the past decade, and I've just found that those properties just haven't delivered for them.
Yeah, I think the pain and gain reports are an interesting one. I've been talking to Eliza, and they're sitting there for years. Just why don't you put in 5% for costs and 3% for sale costs, and just watch those numbers absolutely balloon up on the amount of loss-making sales out there. Because I mean, typically, sometimes first-home buyers don't pay stamp duty, so you could say that's the argument. But there's always a cost to sell, right? So, if you just add these small little tweak to it, I think it would give you a much better reflection, and it would just highlight that, there's some severe parts of, the property market that don't perform, and people who are losing money, and they're the stories that don't get spoken about at barbecues. It's not cool to say that you lost 50 grand on buying a unit that you held for 7 years, and you got done by a spruiker right off the plan, and you don't want to tell people that, right? But then you got the other guy on the other side of the barbie telling how good he did when he bought a regional investment property over the last 3 years. And so the pain and gain report's a really interesting one to sort of track. It shows a little bit of positivity in the housing market. You're right that rising tides lift all ships, but there's always people in that housing market in Brisbane that have done a lot better than others. They're bought on the better streets. They bought the better blocks in the better parts of the suburbs. And everyone feels like they're making money. But, you would see it, Pete. Just some of the clients, if you look at their portfolios that, maybe they bought a similar property for 700,000-800,000, maybe 5-10 years ago, maybe not more 10 than 5, but some of them have performed really well. And if you compared it to some other parts of the market, they still have performed well, but just not as good.
I think you're right. There's definitely a certain anchoring bias to the nominal price that you pay for a property. As you said, if somebody buys something for 700,000 and they sell it for 750, they'll tend to sort of chalk that up as a gain. But as you noted, if you take off the stamp duty and if you take off the legal fees, and when you sell, you've got the agent to pay, and maybe you've got capital gains tax and all of those things. Actually, maybe you've got to include holding costs as well, and people tend to overlook those. And for example, if you've claimed a load of depreciation, you need to back that out as well. And sometimes the gains aren't quite what you think they are. And generally, the longer you own property, the better the results can be. But in the short term, there's a lot of transaction costs. Just to wrap up on the article, the highest nominal gain of LGA markets across Australia was in the sea change region of Kiama, south coast of New South Wales. So the median resale profit, this is a bit sickening to read, $758,000. I used to holiday in Kiama, in inverted commas, every weekend practically when I had a camper van living in Sydney. And I always used to say to Heather, we should buy down here, just stuff living in Sydney. Let's just take the sea change. And look at what prices have done there over the past 15 years since we got married. It's quite a remarkable performance. And finally, hold periods fell slightly to 8.7 years on average. So 2 to 4 year hold periods were the most common at 15% of resales, but they incurred higher than an average loss. So obviously the shorter holding periods generally you're a greater risk of making a loss. And it's also true if you buy brand new, the chance of making a loss does increase. But still decent resale gains of 175,000 for those shorter held properties. So I guess what are the takeaways? Sort of try and buy in popular areas that people are moving to, hold for longer periods, and generally the risk of loss is a lot lower if you're buying an established property at a fair price rather than sort of overpaying for that new stock. I did see actually the Financial Times reported something very similar this week in London, that people who bought brand new are a much greater chance of making a loss.
Yeah, it's funny you say Kiama. Back in sort of 2017, 18, I just had a quick search on my computer, to be honest. And yeah, we were looking for our first sort of family home. We used to do a lot of time down the South Coast, pre-kids, and, sort of, have that whole tree change, sea change. Yeah, maybe we should build a life here. And yeah, we actually looked at a bunch of properties in Berry and Kiama, and it ended up being a bit too far away from the city back then. We thought, with work and kids and family, it just doesn't seem like it's a good move. And maybe we love coming here for weekends, but maybe we won't love it if we spend, all our time here. And is there enough people like us around, or are we going to get a bit bored and agitated? And we ended up then exploring up on the beaches and the inner west of Sydney, and ended up buying on the northern beaches. But yeah, it's an interesting market back then. It's completely shifted from 2018. And I think when a market does shift from a holiday sort of market to a home buyer market, that's when the prices can really run. And that's obviously post-COVID, but also post the extra Sydney boom has forced people out. And it's in those areas, they're very lack of supply as well. So the better properties are few and far between. And, people are looking to buy a home. They haven't really got the time to wait or can't, and they just want to secure something. And they're thinking about capital city prices, often in regional locations, because they're comparing it, because that's their alternative strategy, staying in the city. And so, yeah, it doesn't surprise me it's done so well, but I don't think it was such a safe bet when I was looking at it back in 2018. I just think the market has changed, often due to COVID.
I remember people used to commute from Kiama. This is like 20 years ago, and it was a good 2.5 hours on the train, door to door, and it was just too much. But if you could do that, if you could maybe be in the city 2 days or 3 days a week, maybe it's a bit more amenable. And obviously, if you're a remote worker, then happy days. Just too cold for me down there, but for certainly in the winters. But it's a beautiful part of the world, though. Let's do our third story before we do the listener Q&A. So, macro business, Australian house prices bubble up. So auction clearance rates at a 4-year high. The first home buyer 5% deposit scheme still hasn't even started yet. So that's not until 1 October. House price expectations per Westpac are at a 15-year high. And if you look at the Cotality Daily Dwelling Value Index, the highest rate of growth over the past 28 days since October 2023 is 0.9%. So prices are moving. I suppose the other side to this, Chris, is if you look at what's happened in New Zealand and in Canada anyway, it does show that if you get a real boom in prices, it can later be followed by a correction. At least in real terms, prices are well off the highs in those two countries. So how do you think Australia's cycle will play out? I think in the US, prices more plateaued rather than fell. But in New Zealand and Canada, as the boom came off, then prices have actually eased back quite a bit. Which kind of trajectory do you think will follow, or is it too early to say?
Well, I think, we've got, obviously every market's got different fundamentals. I think, I do think we're living in our properties longer and longer. I think just the cash flow in terms of to do a transaction, to upgrade is just really hard. I think that we're just going to buy a property and then be forced to stay there. This desire to just keep on upgrading upwards. And I do think that we're never going to be able to build enough properties in a reasonable time frame the downsizers are going to downsize into. So I'm betting on a low listings market for some time. And I do think there's just a lot of pent up demand in property markets where, the kids are getting into apartments and they're looking to sort of upgrade, but they're upgrading quite late in life when they've also got the incomes. And I also think the intergenerational wealth, just when it comes down, will get re-leveraged. So, I mean, that would be my take on, the 2030s is people just staying in their properties, not transacting. And then the ones transacting are the ones that have got access to intergenerational wealth or are on the higher incomes. I don't know, what do you think?
Well, yes, I think if you'd have asked me a year ago, I would have said by now we'd be starting to see a better supply response than we have seen. There was a lot of talk about the 18-year property cycle and the market peaking in 2026, and it did feel plausible actually a couple of years ago. But now I'm thinking that supply response, if you look at the reacceleration in immigration and the very lackluster response in supply so far, if anything, it seems like markets are tightening again. I do think the laws of supply and demand haven't gone away, and eventually we'll start to see a building boom, but it could take a lot longer than we first thought. And it may be that the remainder of this decade, as you said, we've just got very low rental listings, very tight markets, and it takes longer, much longer this time around to see that supply coming through. So yeah, I think you're right. I think we'll be just in a very sort of low listing environment for quite a while to come yet. So yeah, I think a bit like in the US, I think people have people kind of by and large stopped selling, and the market, yes, it's at least off the highs maybe in some markets, but generally speaking hasn't really corrected at all. Maybe that's the trajectory we're going to follow in Australia.
Yeah, I'm talking more the housing market here as well. Like the apartment market, is definitely a bit more fluid. I think people do see it as sort of often a stopgap, but I do think as well, the apartment market is going to start to move more into sort of people's forever homes and less driven by investors, more and more driven by owner occupiers who, and I think the apartment market's split into a number of different sort of segments. It's got sort of the bigger, apartments that are in smaller blocks, in premium affluent sort of locations, that have got good lighting on quiet streets. I think they're going to do really well. But then if you compare them to sort of high density postcodes where they're going to just keep on building, I think the old stock is not going to be as good as the new stock. I just think building trends have shifted dramatically, just everything from the style to the quality of materials, to the lighting, and I think that the new apartments that are going to get built over the next 10, 15 years are going to be so much better than the old ones. And I do think that they'll perform much better. I think they'll be bigger, they'll be area, they'll have all the technology and the things that people really want, rather than a lot of these older, newer buildings, these new apartments just don't offer that same lifestyle. They're being built to be cheap and affordable rather than being built for, owner occupiers and families. And I mean, the do townhouse market's an interesting one. I think that will also do quite well. I think on the reason it'll do well is particularly if it's a good quality build, is just the cost to build probably won't go away. And I do think that a lot of people will trade out of the housing market who can't afford to do a build into these sort of newer, townhouses. And so I think because they might go dollar for dollar, yeah, they get half the land, but now they've got a new property, and then that new house comes on the market and then it gets cut up and another duplex goes up. So I think there's, and that also means that there's less houses for sale as well, because they keep getting cut up for duplexes. And I think the other big thing to watch is, as capital cities evolve, some pockets will stay sanctuaries and some pockets will change dramatically. And I think that's why I'm following the New South Wales story so tightly, because I do think that it's really challenging, the old mentality of NIMBYism. But that doesn't mean that every suburb and every part of every suburb is going to change. Certain parts are and some parts aren't. And so you just got to be conscious of that, because that's a big shift if it ends up happening for the next 10, 15 years.
Certainly a two-speed market for apartments that we talked about only a week ago. I think some areas are doing well. Some areas will benefit from the first home buyer boom, but there's plenty of areas that have under-delivered as well. So just time for a couple of your listener questions before we finish for this week. So first question from Falling Knife. Hey, fellas, can you talk through borrowing against assets like shares and crypto? I have a decent portfolio and I don't intend to sell to facilitate buying an investment property. I won't give you too many details, so it's not financial advice. My question is more about the value of assets you can borrow against as a first-time investor. Chris, I'm going to handball this one over to you in the sort of AFL Grand Final theme. So what do you reckon?
I mean, there's typical sort of margin lending products, which, Falling Knife has already probably considered. But there's a whole other sort of level of sort of private lending that And there's a lot of talk recently around, there's all these crypto funds coming. You can now borrow against Bitcoin. Well, you've been able to do that for years, to be honest. You just had to go to sort of private lending sort of options. And so, yeah, I mean, it also, you got to be careful though. I mean, it sounds like he's borrowing against assets, and, it depends on what you're going to use that for, how long you're going to hold the sort of shares and crypto, and, yeah, just making sure that you structure things the right way and you're protected. If some type of lending has margin calls, etc. But yeah, there are definitely ways to do it. It's just often it's not usually the mainstream lenders that will play in this space. It's usually private lending, and often they have a lot of minimum lending amounts, etc. So if you try and do it on a $20,000 portfolio, probably not. But if it's a decent size, bigger portfolio, you probably can. So
I suppose the risk
hopefully,
here, when you look at stock market valuations, I saw the CAPE ratio this week in the US is over 40. That's the only time that's ever happened outside of the dot-com bubble. So price to sales ratio is at an all-time high for the US stock market. So given that the US market is generally the North Star for what happens in every other stock market around the world, there's obviously risks as well. If you borrow against assets that are more volatile, like equities or particularly crypto, you just got to be wary what happens if there's a correction, because that's what market cycles tend to deliver. So, yeah, obviously be aware of the risks as well. Another question here from Rapidly Aging. You often say property is a long-term investment, but what does this actually mean? I'm nearly 50. Is it too late for me to invest in property? Well, interesting, because we sort of touched in one of the stories this week on the sort of median hold period being around about 8 years. I think for detached houses now it's closer to a decade on average. I think given the transaction costs we mentioned earlier on, I would say probably around about a decade is kind of is a good hold period to sort of overcome the transaction costs. I mean, there's different ways to invest in property. If you're doing a major renovation to try and flip a property for profit, then obviously a shorter holding period might be more appropriate. But if you're somebody who's looking to invest in a property for the rental return and the capital gain, I mean, you want to hold at least through a full cycle, ideally, I would say. And that's historically been 7 or 8 years on average. So if you think about a decade as a kind of worthwhile investment period, obviously if you can invest in a high growth market and do it for longer, then that would be better, because then gives the compounding effect longer to take hold. And then you can potentially even use that equity to extend the portfolio. But I would say obviously if you're in a good market, longer is better. But what do you think, Chris?
I think one of the biggest advantages of resi property over other investing is the ability to leverage. And so it's often why a lot of younger people are sort of more attracted to it, because they've got limited cash, they've got more borrowing capacity through the banks, and they can leverage their money further. As you sort of get closer to, retirement, that sort of desire to leverage up, work prospects may be great, or they may be a little bit more challenging. You might be after your peak earning cycle. You might be more worried about redundancy, and then other investment options start to become, more and more of an option. Do you start to look for more yield because you're looking to replace your income? Have you missed the opportunities with putting money into super or even buying shares? Maybe you've got heaps of equity in a property, and maybe you can get more exposure buying property versus shares, but it's not that much. And then you might have a limited time frame to retirement, and and if you get a big lumpy asset in retirement, you got to sell that, pay capital gains tax, then you could have kept your shares. And so it starts to get a lot more complicated, I feel. Residential property in particular, investing in your 50s. And I think you really do need some good advice by someone who can put together a bit of a retirement planning strategy for you to start to figure out, well, what do you need to survive on? What's going to protect you as a family? What's your alternative strategies like downsizing? And whereas when you're a bit younger, I think it's a little bit, you've got time up your sleeves, you've got your career ahead of you, you've got less cash, and you can potentially leverage it further. You've got the ability to sort of negative cash flow and negative gear it if you have to. And so, 10 years, I think, Pete, is right. Like, I think definitely when clients come into us in the mid 50s or, and they're wanting to invest in property, it's like, I think you probably should have been doing this 5, 10, 15 years ago, not now. And that's why I do think there's going to be a bit of a mini investment boom. I think a lot of the sort of circa 40 to 45-year-olds are looking at their retirement now. A lot of it due to the cost of living, right? Like, it's pretty scary. You think, God, like, prices have gone up a lot. How much is going to go up over the next 20 years before I retire? And I need to take action now. I can't just be sitting pretty, and I can't upgrade my home. So maybe I should invest. And I'd say that's been a shift in our clients' mindset over the last couple of years, is that I've actually got to do something for my retirement, and super's not going to solve my problems. And I need to start investing now. And you can see that with all investment data in terms of lending. It's been increasing, a lot over the last few years.
Very good advice. Yeah, thanks, Chris. So, you've already told me what you're doing this week, and I'm just got a couple of days in Freo. Then I'll be, by the time this goes to air, I'll be down at the G in Melbourne. So this will be the last time you have to look at me wearing AFL merch, at least for another 6 months or so. So, promise I'll be wearing normal attire next week. Anything else on the agenda for you, Chris?
Don't make promises you can't keep, Pete. If you ended up winning, I'm pretty sure you'll have it on next week. And
have the full guns out.
Yeah, so let's see how you go. My family are a bit of a Collingwood fans. I'm not massively into the AFL myself. Too patriotic to English football, but they had a good win. I was texting my dad when it was on, and they were very disappointed. But good luck on the weekend, and look forward to having a chat next week.
Yeah, sounds good. Thanks, everyone. Send in your questions, and also come and join us at the Rask Community Forum, community.rask.com.au. It's all free, and come and pose your questions and have a chat there. And look forward to seeing you next week. Cheers, Chris.
Thanks, Pete.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.